In the world of Forex trading, success and failure often come down to the smallest details. Most beginners step into the market with dreams of financial freedom, luxury lifestyles, and a quick escape from the 9-to-5 grind. They see charts moving up and down, hear stories of traders who turn small accounts into millions, and immediately believe they can replicate the same results without much preparation. Unfortunately, this mindset is the first trap, one that has caused countless accounts to vanish in just a few days or weeks. The reality is simple: Forex trading is not a get-rich-quick scheme. It is a high-risk, highly competitive field where only a small percentage of traders remain consistently profitable. But here's the good news: those who do succeed are not necessarily smarter, luckier, or more gifted than others. What separates winners from losers is the ability to recognize and avoid the costly mistakes that destroy accounts. These mistakes are not just small errors. They are deadly because they silently drain your capital, erode your confidence, and push you into emotional trading spirals that are hard to recover from. What's worse, many traders repeat them without realizing they're the reason behind their failures. If you've ever blown an account, quit out of frustration, or wondered why your strategies never work, chances are you've fallen into one of these traps. In this breakdown, we will uncover the 7 deadly mistakes that blow trading accounts. From over-leveraging to revenge trading, you'll learn what each mistake looks like, why traders fall for it, and most importantly, how to avoid it. Each point will be practical, relatable, and backed by solutions you can apply immediately to protect your capital and grow steadily. Think of this as your survival guide in the Forex battlefield. By the end of this article, you'll not only know what destroys most traders, but you'll also have the mindset and tools to make sure you never repeat these errors yourself. So, if you're serious about becoming part of the small percentage of traders who survive and thrive in this industry, stick with me as we dive deep into these 7 mistakes. The lessons here could be the difference between another blown account and your first step towards real profitability. Mistake 1: over-leveraging. One of the fastest ways traders blow their accounts is by falling into the trap of over-leveraging. On the surface, leverage looks like a gift, a chance to control large positions with only a small amount of capital. Brokers advertise it like a golden ticket: trade with 1-to-500 leverage and maximize your profits. To a beginner, this feels like free money, an opportunity to turn $100 into $10,000 in a few trades. But in reality, over-leverage is a double-edged sword, and most often, it's the sword that cuts your account into pieces. Leverage magnifies not only profits, but also losses. For instance, if you trade with 1-to-500 leverage, a tiny 0.2% move against you can wipe out a huge portion of your account. Many beginners don't realize this until it's too late. They open oversized positions, thinking one winning trade will change their life, but all it takes is a small pullback to blow their capital. This is why over-leverage is known as the silent killer of trading accounts. Why do traders fall for it? The psychology is simple. Beginners come in with the mindset of getting rich fast. They don't have patience for slow growth, so they look for shortcuts. They tell themselves, if I double my account this week, I'll withdraw and trade more carefully next time. But that next time never comes because they blow the account first. The emotional high of chasing quick wins blinds them to the risk they are taking. Brokers also play a role. They know new traders crave excitement, so they lure them in with huge leverage offers. After all, the more traders over-leverage, the faster they lose, and the more money brokers make in spreads and commissions. In other words, the system is designed to trap the impatient. The solution is risk management discipline. Successful traders know that trading is not about hitting home runs. It's about survival and consistency. They never risk more than 1-to-2% of their capital on a single trade. For example, if you have a $1,000 account, risking $10, $20 per trade might seem slow, but it allows you to survive losing streaks and stay in the game long enough to learn. Another solution is understanding position sizing. Don't open trades based on emotions. Calculate them based on account size, stop-loss distance, and risk percentage. Tools like position size calculators exist to help traders make rational decisions instead of gambling with oversized lots. Equally important is developing patience. You need to shift your mindset from how fast can I make money to how long can I stay in the game. If you avoid over-leveraging, you give yourself the chance to compound your profits slowly over time. That's how the 1% of consistently profitable traders think. They're not looking to double accounts overnight. They're focused on sustainable growth. So, the bottom line, over-leverage is not a strategy. It's suicide. If you want longevity in trading, protect your capital first. Think like a professional, trade small, manage risk, and let compounding do the heavy lifting. Key takeaway: leverage is a tool, not a magic wand. Used wisely, it can help you grow. Used recklessly, it will destroy your account faster than anything else. The choice is yours. Mistake 2. Revenge trading. If over-leveraging is the silent killer of trading accounts, then revenge trading is the emotional killer. It happens after a trader takes a loss, sometimes small, sometimes catastrophic, and instead of accepting it as part of the game, they jump back into the market with the goal of winning it back immediately. The mindset is simple. I'll show the market. I'll recover what I lost and more. Unfortunately, this emotional spiral often leads to even bigger losses, blown accounts, and shattered confidence. Revenge trading comes from ego and emotions. Many traders cannot separate their personal identity from their trades. When a trade goes wrong, they feel attacked, as if the market has insulted them. So, in response, they try to fight back. They open larger positions, reduce their analysis time, ignore risk management, and chase setups that don't even exist. Their only goal is to recover losses quickly, but the faster they push, the deeper they fall. Why do traders fall into this trap? The answer lies in human psychology. Losses trigger pain in the brain, similar to physical injury. When you lose money, your brain feels like it's been hurt. Naturally, you want to make that pain go away, and the quickest way seems to be jumping right back into the market to win. This emotional impulse is extremely powerful, and without self-control, it takes over your decision-making. Revenge trading also creates a dangerous cycle. You lose, then you try to win it back quickly. You take another impulsive trade, which often fails because it wasn't planned properly. Now the loss is even bigger, which makes you angrier, leading to another desperate trade. Before you know it, your account is drained, and you're left wondering how it all happened so fast. Professional traders know that losses are part of the business. No one wins 100% of the time. In fact, even the best traders in the world may only win 50–60% of their trades, but they remain profitable because they manage their risk and don't let emotions dictate their next move. The difference between a professional and a beginner is not that professionals avoid losses, but that they handle them rationally. The solution to revenge trading lies in discipline and self-awareness. First, accept that losses are inevitable. A single losing trade does not define you or your future as a trader. Instead of focusing on making the money back right away, shift your mindset to protecting your capital and waiting for high probability setups. Another solution is creating a cool-off rule. For example, after 2 consecutive losses, step away from the charts for at least an hour, a day, or even a week if necessary. This prevents you from making emotional decisions in the heat of the moment. Many experienced traders have rules like if I lose 5% of my account in a week, I stop trading until next week. This allows emotions to reset and logic to take back control. Also, keep a trading journal. Write down not only your entries and exits, but also your emotions during trades. Over time, you'll notice patterns. Maybe you always revenge trade after a big loss, Or maybe you break your rules late at night. Identifying these tendencies helps you prepare and prevent them in the future. Finally, practice detachment. You are not your trade. A losing trade does not mean you are a bad trader. It simply means the market didn't align with your analysis this time. If you detach your self-worth from your results, you will stop feeling the need to fight back against the market. Key takeaway: revenge trading is a trap set by your own emotions. The only way to escape is by stepping back, resetting your mind, and following your plan with discipline. Remember, the market is not your enemy. It doesn't care about you. It simply moves. Your job is to respond wisely, not emotionally. Mistake 3. Chasing the market. One of the most damaging habits traders develop is the constant urge to chase the market. This happens when a trader sees a strong move already in progress, whether a sudden surge upward or a steep drop, and jumps in too late, hoping to ride the momentum. The problem is, by the time they enter, the move is often near exhaustion. Instead of catching the trend early, they end up buying at the top or selling at the bottom. This mistake is rooted in FOMO, fear of missing out, one of the most powerful emotions in trading. The thought that I might miss this big opportunity clouds logical thinking and pushes traders into impulsive decisions. In reality, the market always offers new opportunities. But when FOMO takes over, traders feel that this is their only chance and abandon their trading plan to act on impulse. Chasing the market often leads to two dangerous outcomes. First, entering late results in poor entry prices with bad risk-to-reward ratios. Even if the market moves slightly in their favor, it usually retraces quickly, hitting their stop loss and causing frustration. Second, after experiencing repeated losses from chasing, many traders develop a destructive cycle. They keep trying to make back what they lost by chasing the next big move, falling deeper into emotional trading. The underlying issue here is a lack of patience and discipline. Profitable traders know that waiting for the market to come to them is far more effective than running after it. They plan their entries at strategic levels, key support and resistance, retracements, or breakout confirmations rather than randomly entering in the middle of volatile moves. To overcome this mistake, traders must learn to trust their strategy and accept that missing a trade is not the end of the world. The markets will always create new setups. Developing the mindset that opportunities are endless helps reduce the emotional grip of FOMO. In fact, missing a trade can sometimes be a hidden blessing, saving you from unnecessary losses. One practical solution is to define clear rules for entries. For example, deciding never to enter a trade after a candle has moved beyond a certain percentage of average volatility ensures you avoid chasing. Another technique is to set alerts at specific price levels, rather than staring at the screen and reacting emotionally. The most profitable traders cultivate patience, discipline, and trust in their systems. They know that successful trading isn't about catching every move, but about catching the right moves at the right time. By resisting the urge to chase, and instead focusing on high-quality setups, traders shift from gambling to professional decision-making. In conclusion, chasing the market is a silent account killer. It drains both capital and emotional energy, leaving traders frustrated and impulsive. But with the right mindset, preparation, and trust in your plan, you can overcome this urge and trade like the top 1%, calm, patient, and strategic. 4. Ignoring risk management. One of the gravest mistakes traders make often unknowingly is neglecting proper risk management. Many beginners enter trades with a fixed mindset of how much they want to win, but very few calculate how much they can afford to lose. Without risk management, even a seemingly successful trading strategy is doomed to fail. Risk management isn't just about using stop-loss orders. It's about managing your position sizes, maintaining a healthy risk-to-reward ratio, and ensuring that a single trade never has the power to wipe out your entire account. Think of it like building a house. No matter how beautiful the structure looks, without a strong foundation, It will collapse when storms hit. The market is unpredictable, and storms will always come. Traders who survive and thrive are not the ones who avoid losses, but the ones who manage them wisely. A common mistake is risking too much capital or a single trade, sometimes 10% or more of the account. This overexposure amplifies the emotional stress because the stakes are too high. Losing that trade can cause panic, lead to revenge trading, or even push a trader to blow their entire account within days. In contrast, professional traders typically risk only 1 to 2% per trade, protecting themselves from catastrophic losses. Another overlooked aspect is the risk-to-reward ratio. Many traders enter trades with a 1-to-1 ratio, where the potential gain equals the potential loss. Over time, this can destroy profitability because markets are never perfectly balanced. Smart traders aim for at least a 1-to-2 or 1-to-3 ratio, meaning their potential reward outweighs the risk. This ensures that even if they win fewer trades, they can remain profitable in the long run. Ignoring risk management often stems from impatience and greed. New traders want to double their accounts quickly, so they gamble instead of trading with discipline. But successful trading is a marathon, not a sprint. Risk management is your safety net, the shield that protects your capital, so you can keep playing the game long enough to master it. In short, risk management is the difference between those who last in the market and those who don't. Traders who ignore it are building castles on sand. Those who respect it are laying bricks on rock-solid ground. Mistake 5. Chasing the market. One of the deadliest mistakes traders make is chasing trades after missing an entry. This happens when a trader watches the market move without them, panics about missing out, and jumps in late. Instead of waiting for a proper entry, they enter impulsively, often at the peak of a move. This behavior is rooted in FOMO, fear of missing out, and it almost always leads to losses. By entering too late, the trader has poor risk to reward and becomes vulnerable to sudden reversals. Worse, once the position goes negative, they may hold onto it out of hope, compounding the loss. Why traders chase the market? Emotional attachment to price movements. A false belief that something is better than nothing. Pressure to make quick profits. Lack of a clear trading plan with defined setups. The consequences: entering trades at high risk points. Increased stress and overtrading. Losses that were avoidable with patience. How to avoid it? Accept missed trades. The market gives infinite opportunities. Missing one doesn't matter. Set predefined entry rules. Only enter if all conditions align. Wait for retracements or confirmation. Don't buy the top or sell the bottom. Remind yourself, patience equals profit. The best setups take time. The most profitable traders know, not trading is also a trading decision. Click the like button and subscribe for more insightful videos to make you one of the top consistent profitable traders.